Today, we're digging into a company called Xenotech, and it's a perfect example of a situation investors run into all the time, where the exciting story a company tells seems to point in one direction, but the cold, hard numbers point somewhere else entirely. It's the ultimate showdown, narrative versus the numbers. So let's just jump right in. If you're only looking at the stock chart for Xenotech, you'd probably get pretty excited. I mean, what some technical analysts see here is a classic Elliott wave pattern. The theory basically is that the stock has gone through this big correction, it's hit rock bottom, and now it's like a coiled spring, ready for a huge rally. This is the kind of chart that gets traders talking. But here's the question we have to ask ourselves. Does this pretty chart actually reflect what's going on with the business itself, or is there something else happening under the surface? That's what we're going to figure out. First, let's stick with the chart. Let's break down exactly what it's suggesting and see why it has some people feeling so optimistic about Xenotech. What you're supposedly seeing here is a textbook ABC corrective wave. So you get that first big sharp drop, that's wave A. Then you see a little rebound as some buyers think it's a bargain, that's wave B. But that rally doesn't hold, and it leads to that final grinding decline in wave C, which seems to be bottoming out right around that $2 mark. So the whole bullish case boils down to this. The pain is over. The stock has been beaten down, it's deeply oversold, and the next logical move, according to the pattern, is a powerful new surge upwards. You even have some analysts slapping a price target on this thing between $5 and $8. I mean, if you're just looking at the technicals, that's a really compelling story. Okay, but a stock isn't just a squiggly line on a screen, right? It's a real business. So let's pivot from the chart and take a look at the business itself to see if the hype actually holds up. First up, their drone business. The promise sounds incredible. They're going to disrupt the entire defense industry with cheap, AI-powered drones. But the reality? This is one of the toughest markets in the world to break into. You've got massive companies like Lockheed Martin, insane certification hurdles, and government sales cycles that can take years. It's a real David versus Goliath scenario, and in this case, David has a team of about 30 people. Then you've got their software as a service division. The story here is that they grew super fast by buying up 21 different companies. Sounds good, right? Recurring revenue, sticky customers. But when you actually dig in, you find out these weren't exactly thriving businesses. They were mostly companies in financial trouble. So that growth story is really just a story of trying to stitch together a bunch of failing businesses, which, as you can imagine, is incredibly risky. Oh, and right, there's also a quantum computing division. For now, though, this is really just an idea. It doesn't bring in any real money, and again, it's trying to compete in a space with absolute giants like Google and IBM. So if the actual business units are a little shaky, you have to ask yourself, how are they paying for all of this? This is where we need to follow the money. And let me tell you, this is where the story takes a very, very sharp turn. 230%. In just the past 3 years, the number of Xenotech shares out there has grown by 230%. Now, that's not growth, that's dilution. Think about it this way. If you own a slice of a pizza, but the owner just keeps adding more and more slices to the pizza, your piece gets smaller and smaller. That is exactly what's been happening to Xenotech shareholders. And this table right here tells you exactly why they have to do it. Just look at these numbers. The company brought in about $8.4 million in revenue. Okay, but it had a net loss of $26.4 million. They are burning through cash like crazy. This isn't a company that's funding its own growth. This is a company that is surviving, literally, by selling off pieces of itself to new investors. You can see this really dangerous cycle playing out. The main business loses money. Trying to grow the business costs even more money. So the only way they can keep the lights on is to sell more shares, which of course just waters down the value for everyone who already owns a piece of the company. And this might be the single biggest red flag of them all, a negative gross margin. What this means is that for every dollar's worth of product they sell, it actually costs them more than $1 just to make and deliver it. That's before you even pay for marketing or research. The basic business model is broken. The more they sell, the faster they lose money. So at the rate they're burning through cash right now, the company has about 7 months of money left in the bank. After that, they're going to have to go out and raise more money again. The clock is always ticking. All right, so with those financials in mind, let's try to figure out what Xenotech's intrinsic value might actually be. We're going to forget the chart, forget the hype, and just focus on its ability to generate cash. As of this analysis, the market is pricing the stock at around $2.15 a share. That's what people are willing to pay for it today. But here's the real multi-million-dollar question for any long-term investor. Based on its actual fundamentals, what is this business really worth? The calculated intrinsic value, just 39 cents per share. The gap between the market price and the fundamental value is, well, it's enormous. So where is that huge difference coming from? This quote really just says it all perfectly. More than 80% of the stock's current price is what you'd call a narrative premium. It's not based on the business today, it's based on hope and on hype for a future that might never happen. So this leaves us right in the middle of a massive dilemma. We have two completely different stories being told about the very same company. On one side, you've got the narrative from the chart. The correction's ending, a big new wave up is coming, and the price could go to the moon. But on the other side, you've got the story from the numbers. Constant negative cash flow, massive dilution for shareholders, negative gross margins, and a business that appears to be overvalued by over 450%. And that really leaves us with the final question. And this doesn't just apply to Xenotech. It applies to any company you look at. When a stock's exciting story and its hard numbers are telling you two completely different things, which one do you listen to?